What if the biggest critic of the AI boom just bet $1 billion that powerful tech stocks could fall? Third, competition is rising. AMD gains traction, Intel re-enters, and big tech designs its own chips. When customers become competitors, pricing power weakens. These companies are at the heart of AI transformation. Why bet against the most important tech wave since the internet? Nvidia powers AI, and Palantir deploys advanced government and enterprise AI. They are winning contracts and capturing global mindshare. Some call them unstoppable. But what does Burry see that others don't? Most headlines are wrong. The $1 billion number is misunderstood, the position's meaning is unclear, and the deeper message is often missed. Today, we'll analyze what Burry bought, why Nvidia and Palantir, and what risks he sees. We'll explore what would make him right or wrong. If you invest in AI, you must understand this story. This isn't just one man's bet. It reveals what lies beneath the AI gold rush. Let's begin. Everyone says Burry is short $1 billion of AI stocks. But that's not true. His fund disclosed put options on 5 million Palantir and 1 million Nvidia shares. That's $1.1 billion notional value. But notional doesn't mean he invested $1 billion. It's the value of the reference shares. The 13F filing doesn't reveal the strike price, expiration, hedging, spread details, or if trades were closed. So, the actual money at risk could be a tiny fraction. Burry isn't necessarily making a massive all-in short. This could be a hedge, a relative value trade, a volatility play, or a short-term tactical move. But his choice of Nvidia and Palantir is telling. These are AI narrative leaders, and Burry is positioning against perfection. They have the most to lose if AI expectations soften. First, valuation price isn't perfection. Nvidia's valuation assumes uninterrupted data center demand. Any slowdown would cause sharp repricing. Palantir's valuation assumes rapid commercial AI adoption. If deals delay, sentiment breaks. Second, concentrated customers. Nvidia relies heavily on hyperscalers like Microsoft, Amazon, Google, and Meta. If two cut spending, earnings get hit. Third, competition is rising. AMD gains traction, Intel re-enters, and big tech designs its own chips. When customers become competitors, pricing power weakens. Fourth, geopolitical pressure. Export restrictions to China could cap revenue growth. These vulnerabilities don't make Nvidia or PLTR bad. They make them high expectation stocks, which are the most fragile. Burry loves trades where great companies face impossible expectations. Michael Burry is not anti-AI, he is anti-euphoria. In 2006, he saw cracks in the housing market. Today, he's looking for cracks in AI. His logic: AI is real, but priced beyond reality. Key risks he might watch include AI spending slowing in 2026 to 2027 as budgets normalize and demand plateaus. Physical bottlenecks like energy and cooling could slow data center growth. Commercial AI adoption might lag as enterprises take longer to deploy profitably. Sentiment overconfidence, where retail investors believe AI can only go up, creates opportunities for asymmetric downside, which put options can monetize. For Burry, the trade isn't about rejecting AI, but rejecting certainty. What could make Burry right? Hyperscalers slowing GPU spending or AMD taking share faster? Escalating export restrictions, weakening Nvidia pricing, or Palantir missing commercial growth targets would lead to a valuation shock. What could make Burry wrong? Exploding sovereign AI spending, Nvidia maintaining its tech lead, or new architectures outperforming? Palantir scaling commercial AI faster, or AI demand outpacing supply? If AI infrastructure accelerates, his puts could expire worthless. This isn't a simple bet. It's a belief that expectations have run ahead of fundamentals. So what should investors take away? Burry's filing isn't prophecy or a crash signal. The lesson: when valuations assume perfection, even world-class companies become vulnerable. Nvidia and Palantir may be long-term winners, but their stock prices reflect enormous expectations. Burry reminds us, bigger the hype, smaller the error margin. You don't have to agree, but you can't ignore him. Stay rational, analytical, and never assume any asset can only go up.